Okay, let's get into this. We're doing a deep dive into the Nevada commercial real estate market, looking at the data from November 2025.
Right.
And the big theme that keeps coming up is correction and consolidation. But I think the real story is this decoupling we're seeing.
Exactly. The North is behaving completely differently from the South and different asset types. Well, they're on different planets.
So what does that mean for you, the listener?
It means the era of, easy money is over. But the core reasons to invest in Nevada, the tax advantages, the population growth, that's all still there.
It's just not a rising tide lifting all boats anymore.
Not at all. You need that granular street-level knowledge now. You can't just buy Nevada. You have to know if you're buying Vegas industrial or Reno office.
So let's start with that stress test. Las Vegas industrial, the vacancy rate just pushed past 10%.
Yeah.
That's the first time in a decade, right? It feels like demand is just collapsing.
You'd think so, but it's not really a demand story. It's overwhelmingly a supply-driven issue.
You explain that.
Developers just delivered 1.8 million square feet of new space in the third quarter. It's a huge glut of inventory hitting all at once.
And that shifts the power dynamic.
Completely. It's a tenant's market. We're seeing concessions like 1 to 2 months of free rent, even shorter lease terms like 12 to 24 months, which was unheard of before.
On top of that supply issue, you have a headwind from tourism. Visitor volume was down almost 9% in September.
It was, and that slump is very specific. It's heavily tied to a drop in international visitors, especially from Canada.
How bad was that drop?
Canadian arrivals fell almost 24% in October. That is a brutal hit for anything Strip adjacent.
Okay, so let's pivot. Let's talk about the bright spots in Vegas. Taxable sales are down a bit, so consumers are tightening their belts. Why is retail thriving?
It's a simple structural reason. Scarcity.
Scarcity.
Yeah, there's been almost no new retail construction for 5 years. So vacancy is at a historic low, between 5 and 6%.
And the grocery-anchored centers are holding everything together.
They're the anchor. Absolutely. Look at the Island Pacific supermarket lease. That was a massive, nearly 34,000 square foot deal. A huge vote of confidence.
Okay, what about the office sector? We always hear this phrase, float to quality. Is that just a buzzword or is it real?
Oh, it's very real. You can see it in the numbers. Class A buildings in places like Summerlin saw a positive net absorption.
And just to clarify for everyone, positive net absorption means more space was leased than was left empty.
Precisely. Meanwhile, the older Class B and C buildings saw negative absorption. People are leaving those for better spaces. And then you have the medical office buildings, the MOBs. They are totally decoupled from the rest of the market. They're seen as recession resistant. The state itself just bought a 6-property portfolio for over $54 million.
Wow. Okay, let's head north. Reno seems to be running a completely different playbook. The unemployment rate is tighter, 4.4%. What's the biggest surprise there?
The office market. It's absolutely defying the national gloom and doom.
How so?
Rents are up over 11% from last year, and vacancy actually declined to 7.1%. That's all driven by a more diverse economy, with all the manufacturing and logistics they have.
And their apartment market is also looking strong to the future.
It is, and again, it's a supply story. The pipeline for new multifamily construction in Reno shrank by over 70%.
So once the current inventory gets absorbed,
rents are poised for significant growth in 2026. Developers just slammed on the brakes.
So putting this all together, what's the forecast for next year?
I think 2026 is shaping up to be what you could call a great thawing.
A thawing.
Yeah. As the capital markets get back to normal and borrowing costs stabilize, you'll see money come back into the market. That should compress cap rates for the best assets.
Meaning those prime industrial and retail properties will get more expensive.
Exactly.
So let's leave our listener with this. Developers have stopped breaking ground on new industrial projects in both Vegas and Reno. So the question for you is, how quickly will today's tenant-friendly market flip back to a landlord's market?
A good question.
That supply overhang is going to clear out, probably by late 2026. This window to acquire assets at, these dislocated prices is open right now. But for how long?
Something to think about.